Hey traders, welcome back to another video. Today we're discussing a little bit about my options trading strategy and my style of using options to help complement what I do in the markets. As we get started with this, let me just clarify that selling options for premium is not a holy grail, but it is a very high win rate trading strategy that I personally use. I'll go into all the details about how I personally use it to help me smoothen out my equity curve. I trade a lot of trend following with fundamental analysis and trailing stops, which I discuss very heavily and frequently on my channel. But the downside to trading for big gains with a trailing stop is that you have periods of drawdown, losing streaks, and the market's just not following through very well. Well, this strategy, the selling options for premium, is a remarkable way to complement that and helps to smoothen my personal trading equity curve and has been a really great tool to diversify trading strategies for me personally. So today we're going to be talking about selling options for premium and how I like to think of this as a way to trade in a similar fashion to how insurance companies make money. Not only that, the cool thing here is that I actually think that selling options with proper risk management is one of the easiest ways that I know, or the simplest, I should say, simplest ways for a trader to actually put an edge in their favor, even if it is slight, and make more money than they lose money as long as they, again, have a very conservative approach in the markets. Let's dive in. First of all, a lot of traders on my channel may not be super familiar with options or are newer to them or still learning about them. So these next few minutes, I'm just going to go over the basics of what options actually are. Just like in Forex, you trade lots. In futures, you trade contracts. In stock market trading, you trade stock shares, etc. Everything has a different name or jargon attached to it. In the options world, you can buy puts, you can buy calls, and these are basically bullish and bearish bets. Now, they are also called call options, put options, but just remember this is different than, and we may also hear the word contract thrown around, but this is different than futures contracts. Options trading can be traded in many, many different markets. In fact, almost all markets allow you to trade options. They are essentially bets on what market activity may do next, as opposed to just simply buying or selling something. Buying a call or buying a put option is a bit of a bet. We're going to talk about what a contract is. We're going to talk about what is a premium or a credit, what are strike prices and expiration dates. And I know all of this can sound complicated and confusing, but with a little bit of practice, this stuff is really not that difficult and actually makes a lot of sense to practical traders who want to put the edge in their favor and trade a slow and steady type of approach. First, let's go through the basics. What are calls and puts? A call option, call options are financial contracts that give the option buyer the right, but not the obligation, to buy a stock, bond, commodity, or other asset or instrument at a specified price within a specific time period. And a put is the exact opposite. A put option is a contract giving the option buyer, the put buyer, the right but not the obligation to sell or sell short a specified amount of an underlying security at a predetermined price within a specific time frame. Now, I know a lot of language there, so let's actually we'll get into some really simple examples in a second, but we need to understand what contracts are first as well. So in the options world, one contract represents 100 shares of the underlying symbol. Now, the put or call buyer pays a premium for the right to the shares, and the seller of a put or call contract receives a premium. Remember, these are bets on underlying shares, so one person pays for the right to take the bet, and the other person offers the bet. Again, kind of a player and a casino model, if you will. Now, this premium is actively changing in the options market. And if you want to buy a call or put, in both of those cases, you want premium to rise. You pay a certain amount of premium for a contract. You want that contract to rise in price. And if you sell or short a call or put, you actually want the premium to fall. We'll talk more about that in just a second, but let's go through a really simple example because I know the last two shares might have scared you a little bit, but I promise it'll start making sense if you stick around with me. So let's talk about just a very simple, straightforward, long call example. So let's say that I am bullish on Apple stock, ticker symbol AAPL, and I think it's going to go up. So let's say it currently trades at the time of recording this around $237 per share. So what I could do is I could go buy $237 of Apple and get one share, or I could consider doing a call contract, which is essentially a more leveraged way to put my risk out there and make a lot more money or lose a lot more money very quickly. So I could buy one out of the money call contract at $245. Now, why is it out of the money? Let's stop right there. Because $237 is the current price. If we're talking about buying a call that's up at $245, that's out of the money, meaning prices are not trading above or at that price since this is a call option. Expiring about 1 month away. So we have 1 month. Let's basically say that we think Apple's going to trade up in the next month, and we're going to make a good bit of money if the price is above $245 at the end of the month. Now, the way this works in the options world is that if I want to buy that contract, if I want to make that bet, someone has to offer me that bet or take the other side, basically saying, I'll pay you the money if you're right. So somebody else out there, let's say I want to buy this call option, someone else out there basically wants to offer me the bet. They say, okay, well, I don't necessarily think Apple will go up there, but if it does, I'll cover the bet. And what that means is that they're going to have to collect from us a premium. Now, when you're doing this in the options world, this is not some negotiation table situation. It's all done electronically through the options chain or the options market. The debit or cost of the trade, right? We want to put this bet on. Okay, the seller of this option is going to take $2 in premium. So for me to buy this contract, this call option, which at $245, which expires a month away, I'm going to pay $2 in premium right off the top, right up front to the seller. So what that means is I'm giving them $2 in premium, but it's not just two, singular dollar bills. We're going to pay $2 per contract, and a contract represents 100 shares. So we're going to, in total, pay them $200. So we have to be clear about this. When we take this call option, what's in it for us? Well, we get access to 100 shares of Apple for just $200. However, there is some context here. We cannot get that $200 back. The second you spend that $200 goes right into the option seller's pocket. And at the end of the day, we as the call option buyer get the right to play with these shares essentially, right? So 100 shares have been essentially given to us just for $200 until the expiration date. So if I bought one contract, I would control 100 shares of Apple, which is $23,700 worth of Apple for just $200. However, there's some catches, right? The contract has some conditions. So you can clearly see that if you are very correct in both timing and direction, if my idea that Apple is going to go up is right, buying calls or puts, if I was bearish, can be very lucrative, even for small accounts. But I'm showing all of this, and you might have said, well, Nick, didn't you say you like to sell options? We'll get to that in a second. But first of all, I just want to talk about the appeal. This is the player side appeal of the options market. A lot of people like to buy options for different reasons that we'll discuss in a moment. But a lot of times people who you see on social media, they're talking about their huge wins in options world because you can, if you're very correct, make a lot of money trading options on, the buying puts, buying calls side. But personally, I don't like to do that as much because this chart right here. Okay, so if we take a look at this chart, you'll see that there are a couple different variations. We've got the pink lines and the blue line. So this is our trade that we just discussed as an example. So we're talking about Apple stock, and let's say that we bought that $245 call. So again, price is right here, and we're saying at the expiration date, which is this vertical dotted line, if the price is trading at or above the $245 level, our option would be considered in the money. However, remember, we paid $2 per share for this option contract. So our break-even level is the call the call strike price, $245, plus the premium that we paid, $2. So for us to make money, the price has to be above $247 per share. If it's above there, then absolutely this call option is going to make us a lot of money. But most of the time, the call option is going to expire worthless. What do I mean by that? Well, look at this. If the market goes down, this call option is totally worthless. If the market goes sideways, this call option, totally worthless. If this market even goes up, if we were right that Apple would go up, but it didn't go up far enough, we could still lose money on this call option. And finally, we're only going to really make good, significant money if the strike price is well below the final price at expiration date. So my point with this is you can make money buying options, but it's difficult. You have to be both right in the timing of when you actually buy the call option, as well as the direction of the move. And not to mention the magnitude of the move. You need direction, you need timing, and you need magnitude of the move, all to work out perfectly well for you to really make a significant profit buying options. So as you can see, if you do get the direction and timing correct, buying options, the payout actually can be very impressive. But again, that is a big if you get direction and timing correct. How many times in the market have you been correct about the direction, but bad about the timing? Or your timing was great, but your direction was the exact opposite. But to proceed with the example, if we bought $245 calls on Apple that expired 1 month away, and the price is in fact trading at $260 per share, right? So it really beat that 245 call number. Our return would be $260, which is the market price, minus our strike price of $245. Then take out the premium, so add 2 to that. So $247 was our break-even price, which puts us at a $13 profit per share. Now remember, we rented essentially 100 shares. So 13 times 100 shares makes a $1,300 profit, or a 650% return on investment. You can see why options are very attractive. It sounds literally like when you go to the casino and they talk about tripling or quadrupling your money very quickly. You can see why options are very attractive to speculators and people who have really big hopes for, ginormous moves. But I'm coming to a sort of arch here where you can probably hear it in my tone that I'm not a big fan of actually buying options that often. Note that there are times where buying options actually can be great. So let's talk about it. What are some reasons to buy a call, which is a bullish bet, or a put, which is a bearish bet? So there's a few reasons, and some of them are more practical than others. Number one is actually possibly one of my favorite reasons. It's basically hedging or buying some protection. Think about our option example that we just did with Apple. You only had to put down $200 in order to gain access to almost $24,000 worth of Apple stock. That's a pretty good leverage bet, especially if, let's say, I have a bunch of long positions in Apple and I want to hedge my bets, or I'm holding long term into a bunch of stocks and I want to hedge my portfolio in case of a market sell-off. That is one of the most common reasons people use the options market, actually, is to hedge their portfolios that they're holding long term on. A quick example would be if you own 100 shares of Apple, but you think it could come down for a bit, or you just know the market's likely to be very volatile for the next few weeks, you may choose to buy a put to protect yourself. And this may sound complicated, so I won't go into some deep diving option strategies, but certain options trading strategies do involve buying and selling options at the same time, or buying options with different expiration dates, or buying calendar options. There are many, many different ways that options traders are using the options market. They may be buying some and selling some at the same time. The point is, there's always people out there who are looking to buy and sell options. It's a very liquid exchange. And the third one is, and unfortunately, the way that I think most retail level traders use options, which is speculating or using options for very leveraged bets. Basically, if you've heard of Wall Street bets, this is the tried and true methodology, which is basically buying very far out of the money calls, which are very cheap, or very far out of the money puts, which are also very cheap, and just hoping and praying that the market makes a ginormous move where your payout would be ginormous. Again, a bit of a jackpot casino style of trading that I personally really don't see any merit to doing. Now, you may get really lucky, and there are other times where there's a healthy level of speculating. I mentioned earlier that I make, speculative or trend following based bets through just straight buying or selling shares. But I don't personally like to add the timing condition of buying options. In fact, I actually like to use the timing aspect of options to my advantage by being an options seller. I'll talk about that in just a second. And just as a reminder, when an options trader buys a call or a put, they pay a debit right up front to the option seller who essentially insures the trade. Remember, we hinted at insurance company style at the beginning. We'll get to that soon. So again, we painted the picture for buying options, and I want to talk about some of the drawbacks really quick. For most scenarios, out of the money calls and puts will lose the full premium at expiration date, meaning most of the time, when you pay that $200 for Apple shares with a call option, or you pay $500 for a put option, or $300 or $200, most of the time, out of the money calls and puts will expire worthless, meaning your money goes right down the drain. Also, historically, the vast majority of options contracts do end up expiring worthless. Another observed phenomenon in the options world, which is very much why I like to be an options seller most of the time, is that most of the time implied volatility, which is a complicated thing, which we're not going to get too far into in this video. I encourage you to look this up. Implied volatility is essentially the market's implied or expected move in the coming 30 days or 15 days, however long the expiration date on the underlying option actually is. So the implied volatility is usually actually greater than what actually happens in the market. Most of the time, as a quick example, most of the time the market prices things to move $15 and they actually move $12. Most of the time the market implies something's going to move $20 and it actually moves $16, right? So most of the time, and this is an observable throughout the history of the market, this is usually what happens. Not always, but usually, more often than not, implied volatility is greater than actual volatility. And what you might be hearing is the same thing that I love about options selling, which is that options prices are usually expensive. In actual terms, people are usually, who are buying options, overpaying for the options that they're buying. And this means as an options net seller or someone who shorts options premium, most of the time, option sellers have the edge. Let's think about it. In roulette, the casino, right, the game where you spin the wheel and the ball tries to go into one of the red, black, or green slots, most of the time, in actual terms, the casino has a very slight edge if you choose red, black, or green. And over many iterations, if you keep playing roulette, it is 100% guaranteed that you will lose money if you play long enough. In options selling, we know that volatility usually declines over time. Since options are priced both on price action and time, right? Direction, movement, and time, passing time causes options premiums to usually fall. Again, think about it. If your options contract, you pay for more time. So if you extend your call option by 2 months out, you're going to pay more for that option. If you buy a call option 6 months out, it's going to cost you more because you're giving yourself more time to be right. The inverse effect is perfectly to our advantage as options sellers. As time passes on, options lose value, right? So options premiums tend to fall if the price is moving nowhere in slightly in the direction of the strike price or against the strike price, right? That is the beauty of being an option seller, is time passing is an advantage for you. And when you're an options buyer, time passing is a negative thing for you. If you're an options buyer, you want something to shoot in your direction right away. That's why timing is so important. But as an options seller, we can pretty much chill out and wait for time to pass, and that actually helps us in most scenarios. And if you don't believe me, check out this chart. This is UVXY, which is a ProShares Trust Ultra VIX short-term futures ETF. Long story short, this shows volatility in the market. And no matter how far you scroll out on this chart, the further you scroll out, the more you'll just see that this chart over time tends to go down. You'll see there are spikes in volatility. There are ramp ups in volatility where options buyers would have made a lot of money because options premiums grew substantially. But without fail, over time, they typically continue down, 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 and down. I don't know about you, but being on the sell side of this chart seems a lot easier than trying to be on the buy side. Now we get into the fun stuff. Being an options seller is like being an insurance company. Now, I just want to stop and just say that selling options is not at all a get rich quick or easy way to make money. In fact, there are some times where selling options really is no fun, because if the market goes crazy, you got to sort of cover all the risk for everybody, which is not fun. So this is not easy stuff. It is a simple approach, but it's certainly not an easy approach. And I'm going to talk a little bit about this insurance concept, but just know that even insurance companies can go bust. So if you're not properly managing risk, this strategy can get you into a lot of trouble. So I'm just going to preface it with this, and let's talk about this. So let's think about insurance companies for a second. What do insurance companies do? They analyze the risk to insure you or your asset, right? If you're doing home insurance, life insurance, car insurance, wedding ring insurance, whatever it is, right? Travel insurance. They look at you, they look at your asset, and they analyze the risk of your situation and the probability that they're going to need to pay out to protect you or your asset. They're really smart, right? Insurance companies have, not all of them, but a lot of them, the big ones, are very, very smart. They hire brilliant mathematicians. They hire experts in every field to look at things very closely to price their stuff very competitively. If the policy is higher risk, they demand a higher premium, right? If there's a higher chance that they're going to have to pay you out for something, then it only makes sense in their model to raise how much premium they need to collect from you in order to make it worth the risk for them. They then repeat this model over and over and over. And actually, they spread their bets over as many people/assets as possible in order to diversify their portfolio. Inevitably, what's going to happen for insurance companies is that some policies they're going to have to pay out on, but the vast majority of them will never actually lead to a claim and have to pay out, meaning they just collect a ton of premium from most people and they pay out big for a small number of people or policies. And while this model does have dips within it, it leads overall to a gradual but steady profit if the insurance company did their research and managed their risk properly. So now let's talk about option selling. Option sellers mimic this approach that insurance companies do. They analyze the risk to insure, quote unquote, a stock, index, or commodity, and the probability that they will need to buy or short the underlying in the case of assignment. If the asset is higher risk, they demand a higher premium. For example, a penny stock is way higher risk than Walmart stock, or gold is a lot less risky in terms of actual movement than, for example, maybe silver, right? Silver actually moves a lot more on a percentage basis. So different things demand different amounts of premium for the options seller in order for them to feel that the risk is actually worth the potential reward for them. Just like insurance companies, option sellers essentially get paid to take the risk on the behalf of other people. And while that sounds dangerous, and it certainly can be if done inappropriately, spreading out our risk, small bets all over the place over many different symbols, assets, charts, gold, stocks, indices, silver, oil, natural gas, a little bit everywhere with small enough positions, diversifying our exposure, this can actually be a overall pretty profitable approach. It's not going to make you rich quick, and we'll talk about that in a second, but it can certainly allow you to build a diversified insurance type trading strategy. Some trades will inevitably get assigned, which we'll talk about in a second, which is basically your equivalent to having to pay out like an insurance company. But the vast majority, they will not actually expire in the money, the options that you sold, which means you will avoid assignment. This leads overall, if done correctly with good risk management and good research on which things you're selling options on, can lead to gradual but steady profits. So I wanted to take a second here and just pause and show you a platform that I personally use to actually trade options. If you're intrigued or want to know which ones that I use, the link will be down below in the description for this. This is Webull, and if you use my link, there is a great sign up perk available for my audience. You actually get up to 12 free shares, I believe, at the time of recording this video, if you do sign up and deposit with Webull. So check it out down below in the description. You can see I actually have many options trades that I currently have running. So I've sold puts on things like Amazon, Microsoft, Uber, Silver, Pfizer, Nike, Medtronic, Alibaba, ExxonMobil. And again, going back to that, spreading my options exposure over many different charts at once. And you can actually see at the time, all of these are green, and there's just a very high win rate with this strategy, which is why I like it so much. So again, check out Webull down below in the description if you'd like to get some free shares upon signing up. So let's actually do an option selling example. Let's say I have a bullish bias on gold, and I agree that if gold prices drop, I'll buy some shares essentially. I'll trade GLD, which is a gold tracking ETF, and I would sell cash secured out of the money puts. Now we'll talk about what cash secured means in just a second, but out of the money, or OOTM, basically just means if I'm selling puts, they are out of the money to the downside, meaning they're below current price. So let's say that the current price is $245.50. I can sell a $240 put that expires 1 month away on the very last day of 2024 and receive a $2 premium. Remember, now I'm the seller, so I'm collecting that $2 up front, which would equate to $200 in collected premium. And just as a reminder, no matter what happens, I pocket the $200 right up front. So now let's look at some possible outcomes. So you can see it's the opposite of what we discussed earlier. As basically the option seller, most scenarios favor my outcome. So if gold prices go up, I keep the $200. Well, remember, I keep the $200 no matter what. But the big thing here is that if the price is above my strike price at expiration date, that $240 put strike price level, in all of these scenarios, I do nothing but collect a check and move on, and I can do it again next month. The only scenario, the rare scenario, which is prices tank, if that happens, then I have to do something. What happens if prices trade below my strike price at the end of the expiration date? If we're well below that strike price, or even below it at all, what actually happens? And you can see one thing I want to get out of the way here is that some people don't love this about option selling. There is a bit of a negative risk reward most of the time. However, the undefined risk is something that you can define. You can cap your risk on this strategy, which we'll discuss in just a little bit. But you can see in this case, I've mapped out my GLD idea. I'll make $200 anywhere above $240 per share, and I will start losing money below $240 minus my $2 in premium that I collected. So $238 or below, I start losing money, but $238 above, I'm actually going to make smaller profits. But remember, my break-even price is actually $2 lower due to the premium that I collected at the start of the trade. So even though the strike price is $240, I'm making money anywhere above $238. So let's talk about the outcomes. If price is anywhere above the strike price, we're going to make our full profit, nothing happens, and I can then go sell puts again if I want to. Things get more interesting if the price is below 240, which we just discussed. Then what's happening is we're going to get assigned the shares. Now remember, I mentioned I wouldn't mind owning 100 shares of GLD, but that means assignment basically means that we need to honor our obligation to that put buyer. Whoever bought the put, they have the contractual ability to sell shares of GLD at 240 at the end of the expiration, or at any time during the options contract life, right? At any point, they could sell the shares at 240, and I have to be the designated buyer to buy those shares at 240 no matter where it is trading. So essentially, as the insurance provider, quote unquote, we need to pay out the agreed upon policy amount, right? I'm trying to equate this back to insurance policies, right? Most of the time, things work out just fine. Every once in a while, you sort of have to deal with the situation. In this case, we would need to buy 100 shares at $240 per share, regardless of current market price. So the idea here is, again, we were willing to buy the shares. Now the prices has dropped. I have to buy the shares as agreed to. And you might be saying, well, okay, here's the issue for me. That's 100 shares times $240 per share. That's $24,000 of GLD. And for some traders who have larger trading accounts, this might not be a big issue. Little bit of a flex here. That's something that personally I'm comfortable with, but I totally understand not everybody has that kind of trading capital. And so I'm going to talk about, just for a second, some alternative ways where you don't actually need to have $24,000 to front this trade, but you can still be an option seller. Don't worry, you're not completely ruled out if you don't have 24 grand sitting around to buy GLD. Let's quickly review what is called the bull put credit spread. And for reference, someone within our trading community where we share all of our trades does this very frequently. His name is Frank. Him and I have traded together for a long time, and he loves the bull put credit spread because it doesn't require him to tie up so much capital, and he can still be an option seller. So on the screen, you can see again one of Frank's trade examples of a bull put credit spread in action. By the way, all of our trades can be found in the Discord down below in the description. If you sign up for the VIP room, you can get those trade notifications, both Frank's trades as well as my trades, anytime you would like. So take advantage. There's also some discount codes in the description down below. So what is a bull put credit spread? Well, a bull put credit spread is an options trading strategy used when you have a moderately bullish outlook on an underlying security. It's actually a two-step process. So we're going to do two options at once. We're going to sell a put option, meaning you sell an out of the money OTM put option at a strike price below the current market price of the stock. This action generates immediate income known as the premium. So this is what we are already familiar with talking about in this video. The next step, however, is where we cap our downside. The second part is we buy a lower strike price put option. Now this will be cheaper because it's, again, further away. So you're selling a put option that's closer, and you're buying a put option, again, paying a little bit to get another put option that's further away, but will cap your downside risk. So simultaneously, you buy a put option with a lower strike price than the one you sold. This option will cost you less than what you receive from selling the higher strike price put, but it serves as a hedge against significant downside risk. And here's a map of what this looks like. So what you can see here is what we basically do is we still get the upside potential if the market goes up, but if the price drops hard, there is a point in which we have our max loss and we cannot lose any more. Because again, we bought a put at 45. So anywhere below 45, we start being break even, or basically our max loss. We don't gain, we don't lose anymore. And anywhere above 49, we start making money on the spread between these two options that we've one sold, one bought. So let's talk a little bit about how I personally do this strategy or this concept. I look to sell out of the money puts or calls for premium. As a seller of options, I want options to lose value. I want them to expire worthless. I basically want the market to go nowhere, slightly lower, slightly higher. I just don't want it to move strongly against me. In most scenarios, I make money. I typically like to sell 1 month out expiration dates, and everybody has their preference. Some people like to sell weeklies, which are trades that are, 1 week expiration dates away. I like to trade monthlies. It creates enough opportunity for me to be active, but not where I have to be staring at the screen every day, all day long, trading options. Let's talk about deltas. And if you don't know what that is, don't worry, I've got an explanation. I typically like to look for 20 to 30 deltas. Now, a delta can serve as a rough indicator of the probability that the option will expire in the money. For instance, an option with a delta of 0.25 has roughly a 25% chance of being in the money at expiration, though this is not always accurate and should be taken as a rule of thumb rather than a precise measure. So essentially, I like to take trades that have a 70 to 80% chance of making money and not getting assigned. That's the 20-30 deltas. Now, selecting which things you actually sell options on is very important. Which things you choose can make or break you as an option seller. I stick to a basket of assets that I wouldn't mind owning personally forever if I did get assigned. Now, again, the way I trade options, I have the risk of potentially getting assigned. I don't mind that because I also like to sell covered calls, which is another strategy for another video, which is basically when you own shares of something and you actually sell calls against it to collect additional income. But if you're someone who's trading with a smaller trading account, you can kind of ignore that strategy or concept because, again, you're not going to worry about assignment. But for me personally, I'm not afraid of assignment. I actually like to get assigned. It means that I got something what I believe to be at a decent price or a discount. But I stick to assets that I wouldn't mind owning forever. For example, silver, the Dow Jones, Coca-Cola, IWM, which is the Russell 2000, gold, SPY, and many, many more. I have a lot of different things that I don't mind owning as long as the price is right. And this is key because if I sell options and get assigned in the event price goes under my strike price, right? If I'm selling puts and the price goes way down, or I'm selling calls and the price goes way up, I need to be prepared for assignment on that position. And again, I want to reiterate that I don't want to be assigned shares unless I wouldn't mind owning them, right? So I only am ever going to sell what is called naked puts, meaning there is the risk of assignment, or naked calls where there is the risk of assignment where I have to sell or even short something, right? I have to be comfortable doing that. If I'm not comfortable in the underlying or the, what the chart is, I absolutely will not sell an option. And the reason I clarify that is because sometimes certain things can offer you very, very rich premiums, but they're kind of trash things, right? I don't want to be doing this personally on penny stocks because if I get assigned on a penny stock, it might be a worthless company. So I don't want to buy a ton of a worthless company. Here's a quick silver example. So this is a silver put out of the money puts that I sold. And this was a while ago when I actually took this trade, but you can see I sold 2150 SLV July 21st, 2023 puts. And I did 3 contracts and I collected per contract 40 cents, which netted me $120 of profit. And to run through how this concept works, if the price remained above 2150 at expiration date, I would simply collect premium and not be required to buy any shares. I could just then repeat the process, and ideally price would move higher and I have income from collecting the premium, so I don't have to do anything. If the price drops, as we mentioned, below that 2150, I may be required to then buy the silver shares, SLV shares, and as we just talked about, assignment would look like, in this case, 3 contracts, which are 300 shares at $21.50. That's $6,450 of shares. Now, if the price is down at 18 or 19, then I'm going to be immediately in a drawdown on that position, which, remember, that's why I said I'm willing to hold the things that I sell puts on or covered calls on or calls on. I'm willing to hold them even if they're in drawdown, even if that means holding on to them a little bit longer term. And I mentioned this earlier, but if you would like to get the notifications for when I take an options trade, or you'd like to trade options alongside myself, Chris Pulver and Frank, all of us do trade options very frequently. This is something that, again, I have implemented into my trading approach, which is a great way to smoothen out equity curve as long as you have the right tools and understanding of how the options work and you respect them for what they are and do not treat them for something that they're not. You can get yourself in a lot of trouble with options if you trade them recklessly, but I like to use a very simple, low-risk approach of trading options, and it in fact has a lower beta approach, the way I do it, than just buying and holding the S&P 500, which is part of the reason I really like it. It's a bit of a diversification factor, something that I really like. If you'd like to join us inside of the VIP room and learn more, as well as trade options alongside me and my team, you can use code YTVIP and sign up down below in the description. So let's talk about some pros and cons. It has a high win rate. That's the easy one. I'm less concerned with timing and direction. There's a bit of a piece of when you're selling options, it's not so pressing to always be so right about when the market's going to go up. It's going to go right now to this level. There's a lot less pressure on, being right in the direction of something. Again, something can move against you in the options world. And if you're selling options, you can still actually make money. It's a relatively simple approach to the markets, in my view, as long as you have enough patience, small position sizing, and a lot of willingness to sort of just go through drawdowns that are going to happen, it actually can be a very consistent overall long-term trading strategy. And the easy one too is that there is an inherent slight advantage to selling options for premium, as time decay causes most options to expire worthless. Let's talk about the cons. Selling naked puts and calls, which is what I do, does require a larger capital size. And if you accept assignment like I do, you collect more premium, which is the upside. Remember, when you do the bull put credit spread, for example, you do give back some of the credit by buying an option to offset your max risk. So by doing it, why would I do it the naked puts, naked calls approach? Well, it's because you get more premium out of it, but it does require significant capital, and you can have some pretty big drawdowns if you don't size appropriately. And another thing is that it can be very risky on very volatile assets, so you got to be careful on that front. And just like buying and holding the stock market would perform very poorly in a stock market crash, selling cash secured puts the way that I'm discussing in this video definitely still hurts in bear markets, because again, you're getting assigned and markets keep going lower and you're getting assigned more and you're stuck in positions. So it's not perfect, but it is something, even like I said, I'd rather be selling puts as the market's going down and getting assigned than just buying at the top and holding it through a market crash. Here's some pro tips that I've learned over the time that I've been doing this trading approach. Avoid high risk assets. It's not worth it. The premium may look really attractive, but you can get yourself in a lot of trouble if you get assigned on a bunch of very junky stocks. I only employ this strategy on very stable individual stocks, or even ETFs, which are baskets of stocks that I wouldn't mind holding onto for a long term. Let me show you Lyft as an example. Lyft it's rebounded in recent times, but if you take a look at Lyft here, this chart is horrible. Imagine if you had sold puts starting up here and the price went all the way down to $10 per share. If you had sold puts and got assigned, you still got put into a really tough situation. This can happen on any stock, but it is significantly more likely to happen on lower quality companies that are less stable and less, solid balance sheet types of companies like Walmart, Apple, Amazon, things like that. This strategy is not too good to be true. It is very important that position sizing is very conservative, otherwise the drawdowns can be nasty. And this strategy is only worth doing with very conservative risk management, in my opinion. It's not worth doing it at all if you're looking for like high risk, big returns. Option selling is not for you. It is very much a slow and steady, stacking your chips over the years kind of approach. I hope this video was helpful to you. Remember, you can come join us in the VIP room, or if you're looking to get access to Webull, which is the brokerage that I use, everything can be found in the description down below. Thank you very much for watching. If you're looking for a better brokerage, then stick around for a second. I'm going to tell you how you can get some free sign-up perks with great brokerages all around the world. Whether you trade FX or indices, commodities, futures, all of the above, I'm going to show you a really cool way that you can get free sign-up perks with your new account. So if you're interested in switching into a different brokerage, you can get things like deposit bonuses or free stock shares, or you can even get access to some of our products for completely free. All you have to do to find out current perks being offered to new depositors is go to a1trading.com/brokers. That's a1trading.com/brokers. And as you look at that page, you'll see all these different offerings that we've currently locked down for you guys as subscribers, as viewers. Now, of course, we get something out of this. If you choose to use these links, you'll be supporting our page. But in return for the viewers, we've got great sign-up perks available for you guys so that you get some free game just by signing up for a brokerage if you're looking to do so. So check it out on our website. You can find current deals at a1trading.com/brokers. Thanks for watching this video, and on the screen right now you'll see some other options of other videos we put together that might be helpful to you in your trading career. So thanks for watching, and we'll see you next time.